So the next session is going to be Partners and Providers, the Future of Finance at a Glance. We have a great panel discussion, starting with Guy Kashtan, Chief Executive Officer at Rewire, Jos Vazquez, Chief Technology Officer at ClubView, Janine Hertz, Chief Executive Officer at Innovate Finance, Dr. Kumar Bhaskaran.
Sorry, Bhaskaran. Yeah, that's fine. Yeah, it's good.
Okay, amazing.
It's
close enough.
Close enough.
Innovation and Technology Scout, Office of the CTO, IBM Cloud. And moderating this panel, we have Ash Bhatia, Chief Executive Officer at Shipyard Innovation. So Ash, on to you.
Thank you very much. I believe we're competing with sustainability. That's the other event on. So I think we're doing reasonably well, given this is on the back of COP26, and that's the thing that's on everyone's minds. But thank you all for joining and for making yourselves available. I do have some sort of a plan, but we'll see how we get on. I'm guessing we'll freestyle our way through this. But since this is embedded finance, let's start there. If I could, just get some views on how you see embedded finance. Have you seen good examples? Have you seen bad examples? It'll just help us set the context a little bit. If I could go to you, Guy, just to set us in motion, that'll be great.
Sure. So first of all, happy to be here. Thank you. The way I and we at Rewire see embedded finance, it's about the use and integration of financial services and introducing that to customers through non-financial providers. I think it starts many years ago, even at eBay, buy now, pay later type solutions, at flight cancellation insurances, and to today where finance is becoming more available through APIs and other services and becoming something that incumbents and large tech companies want to provide as part of their services, such as WeChat in China or Facebook, WhatsApp in other jurisdictions.
So why is it such a big deal now? Because this has been going on for a very long time, right? If you look at embedded finance, you look at the propositions that have existed. What is so different? Is it the technology? I mean, we have some technologists over here, so why don't we go with IBM? What is the big deal now?
Well, thank you, Ash. First of all, it's great to be in the panel with Guy, Janine, Josh, and yourself. I also want to applaud the audience here for sticking with us till the very end. Just to introduce my bias a little bit, I'm part of IBM, where we are looking at incubating and developing cloud platforms and ecosystems for regulated industries. And obviously, financial services is at the very top of it. I think, to your question, I want to echo the sentiments expressed at the very outset of this theme of embedded finance here in the festival. I think the future of finance is embedded. And why do I say this? Because if you look at the financial services between sources of cash and users of cash at the most expansive way to look at it, and you are unleashing all of that financial services into many different sectors, across sectors, but do it in a responsible and inclusive way, that represents a huge market opportunity. So what is new? That new market opportunity is what is interesting people to look at this. Yes, it is going to be data-driven. Yes, it's going to be technology-inspired. And we feel that, and we work with all market participants, fintechs, financial institutions, system integrators, regulators, as well as people who can provide intermediate value between all of that. And the reason that's important is because the value is going to be co-created. It is going to be a collaboration between all these market participants to create sustainable value. Otherwise, you notice a lot of the companies almost fall off the chasm between the early adoption to the early majority. It's a graveyard of good ideas. So, if So that collaboration is going to happen on top of cloud platforms and ecosystems. That's going to be the medium over which this embedded finance is going to manifest. And that's facilitating it. I don't mean a particular cloud technology. In fact, all the surveys we have done across industries clearly show that the predominant architecture for digital initiatives is cloud. And it's going to be a multi-cloud approach for obvious reasons, for resilience, for being focused more on addressing different market segments. There's a shift from cost cutting to looking at growth. And that's where embedded finance is so exciting.
Yeah.
Go on, Janine.
Well, I was just going to add to that because I absolutely agree with the points that were brought up. And I think to your question as to why are people focused on embedded finance right now, I think there's a couple of different streams to that. But one of those is about a change in customer demand and customer expectation. So one thing that embedded finance does enable you to do is essentially have access to a financial product right when you want it at an immediate level. And we've seen that shift in mindset from the consumer change over the years. And it's also only been brought forward even more by COVID and by the pandemic. So there is that sense of wanting that immediate transaction, that immediate access as well. And I think on the market scope, there are estimates that by 2030, embedded finance will be a market of $7 trillion. So I think that is a huge opportunity there as well. But it has been driven also by this change in consumer mindset and expectation as well.
Yeah, that's right. People are definitely expecting a very different experience when they get on these apps, and when they don't get it. I think that's the reaction because of the power of social media is quite strong as well. So it's almost like you have to do it.
But it's not just B2C.
Yeah.
When we say consumer, the B2B component is huge.
Absolutely.
Massive. And that's just being, touched. I mean, it's not been fully plumbed yet, right? So the opportunities are going to be huge.
Now, the interaction between B2C and B2B as someone that spends most of their life selling, right? I think everything's a story. And the only difference between B2B, actually, you are selling to people whether you're selling B2B or B2C. And the people that you're selling to under the B2B model are people that are experiencing these new ways of interacting as a consumer and are therefore expecting it for their businesses as well and are demanding it. So it's definitely a massive driver. I was looking at the words that have been used to describe our panel, and what struck me is the following text. What are financial institutions doing to preserve market share and acquire new customers? That strikes me as being very threatening. So should they be threatened? Should financial institutions, these large behemoths that exist, be threatened by embedded finance, by the emergence of these companies that are coming through with more modern technology? And how do you feel they should be reacting? I'd love to talk about that a little bit, to lean into some football analogy so I can pull you in because I'm that slick. Should they be playing offense or defense?
I think that it's normal that they feel threatened if they are going to play defense, right? So if they don't want to collaborate, then they should feel threatened. If they want to collaborate, then they shouldn't feel threatened because I think that there's peace of market for everyone. And the most that we collaborate, the most we can evolve, are the better services that we can provide.
And Janine, you are in the business of bringing all of us together, right? You've been doing it, you've been running Innovative Finance for a fair while now. Do you see a marked shift in the desire to collaborate?
Oh, it's a really interesting question because I think there's been ebbs and flows in terms of partnerships between financial institutions, the incumbents, and the startup community. I would say there's also varying degrees and varying levels of success because there is some innovation theater that's still happening, but there are also some real positive partnerships that have been created and win-win opportunities there. I think with embedded finance in particular, partnerships is the way forward in many cases because ultimately you have these incumbents that have the capacity to scale and have the access, and then you have the fintechs that are the agile players that can provide the different technologies and the systems and essentially the platforms to be able to deliver this. So I would definitely say that partnerships is the way forward. I would also highlight in partnerships that we don't only have to talk about the incumbent startup partnerships, because the dialogue can also be about how startups to startups are working. So if you think about embedded finance, one of the first platforms that really took off embedded lending for SMEs was Iwoka's platforms that partnered with Tide, the challenger. And so ultimately that was one of the first initial cases that really came out in this space. So it is important to also look at the partnerships between the fintech community, which we call ultimately a marketplace effect, is also quite key.
Yeah, it's an interesting example because the partnership is actually between organizations that are distributors of solutions and providers of solutions. It doesn't necessarily need to be incumbents and emerging companies. But as habits, all of us have habits, organizations have habits. What needs to change in order to make these partnerships happen more frequently and for them to be more successful? We would have all heard of the term startup tourism, and the industry is guilty of lots of events where startups turn up and there's a dog and pony show and you've got a panel of execs sitting from the large corporate, and then it goes nowhere, or the only objective is the proof of concept.
Yeah.
How do we change as an industry, both sides, in order to deliver more impact? Because there are customers sitting at the end of all of this that are not getting the impact, and there's just all this noise in the ecosystem. What needs to change? I'll open it up to all of you. Please, anyone that wants to take that.
I just want to first address the earlier question and then come to this one.
Please. Kumar's taking charge.
I actually, based on my experience, I don't buy the premise that there is this dichotomous view. That I know that's a popular narrative in some quarters, that there is a dichotomous view of here's the financial institutions who are all incumbents and here's the fintech world, and then there is this threatening thing. Maybe that been a very early start, but we don't see that. Why? Because there are mutually reinforcing incentives. Let me give you examples. So first, if you're a financial institution, you want to have access to as much innovation as possible. In fact, if you're a financial institution and you have an in-house development team and an in-house technical team, you want to keep them on their toes. So it's of tremendous interest for them to look at the ISVs and the fintech world. And on the other hand, the fintechs and the ISVs want to get on as an on-ramp into all of that financial institution network and the clients and their customers and so on. But here's the pragmatic view. What's the challenge? The challenge today is if you want to onboard an ISV onto a financial institution processes, it takes anywhere between 18 months, that's being generous, to much longer. So we need to come up with ways in which the participants can work together. And there are so many facets to it. I don't want to make it seem, simplify it more than it needs to be. But one important thing is de-risking. And that has so many different levels. De-risking at the business level. Institutions like Janine's, who bring people together, actually helps to have that conversation and de-risk. But from a technology standpoint, I refer to it as an ICT risk. Not the traditional ICT acronym, but information security, compliance, and technology at scale. Those are the three big inhibitors for a lot of the fintechs as well as the financial institutions. Because imagine embedded finance where you're linking multiple services. You now have a software supply chain that magnifies or amplifies the vulnerabilities of what you're going to face as a financial institution. So you need to be able to de-risk all of that. And that's where I think technology providers can work together with the industry. And you also need interoperable standards. So we can't ignore the regulators. We had to work with the regulatory bodies to start looking at what should be the normalized data models, for instance, that'll actually help the industry to grow in the embedded finance space.
But who should start this, right? You say we should be working with the regulators. Where does this journey begin? Because you've got two businesses effectively that want to partner with one another. There are a whole bunch of blockers. You mentioned vendor onboarding processes. They're the bane of my life as well. the, the process of making this simpler, where should that begin? Is it industry bodies, industry associations like Innovate Finance? Is it the infrastructure players like IBM Cloud? Is it the emerging players, you know, like Rewire and all the ventures that you're involved in? Where does that process begin, and who has the gravitas and the resources to really drive it through?
They will vary, I think, between geographies and different market segments. I give you examples. So, for example, if you think of central banks, I mean, you wouldn't associate necessarily, you know, frontier innovation when it comes to central banks. They think very carefully and conservatively. But to give you one example, Monetary Authority of Singapore was the very first central bank to create a sandbox for blockchain technology. And you ask them why. Because they want to know, you know, who are all the players and what better way to observe than creating a sandbox where they can actually look at how this technology is shaping up and what regulations need to be adapted for the new technology. And when it comes to meaningful scale, they would step in. That's sort of one model. And you begin to see that all over. I just use them as one example. They're not the only central bank. You look at climate change. Look at the leadership all of the central banks are doing, right? Whether it's central bank digital currencies, looking at climate risk for asset classes, helping create new asset classes as well, all of that. So that's one model. A very conservative player. I just picked a very conservative player in the spectrum. And in the same way, I mean, I think fintechs also have the opportunity to lead in certain spaces. For example, a lot of the innovations happen in the consumer interface. And then they sort of creep into business to business, right? So there the leadership is more on the fintech side and then just come in.
But you hit on a really important point there, which I think is underlined across this idea of partnerships and momentum, in that it can't only be, say, the industry that's moving it ahead. It has to be a collaboration of sorts with industry, but also government and regulator as well have to be driving everything forward. I mean, we served as the secretariat for the Khalifa Review, which has ultimately put together the roadmap for UK fintech to ensure we maintain a leadership position. And very clearly, the result from that review was this need and this necessity to get everyone onto the same page. So you need to have the regulatory framework that enables innovation to thrive while still protecting the consumer, but you also have to have the support and the advocacy of the government to enable these partnerships and this momentum to keep going as well. So it's really everyone has to come together at the same point.
Yeah, a little bit as an echoing. You need every player because all the players play a part in this. And all of them have to benefit out of it, because if one of the players doesn't benefit, why would it like to collaborate, right? So the only way that this could work is just trying to get big players on it and at the same time challenge the players and just try to create some standards, but with the support, obviously, of regulatory bodies. And it would depend, too, on geographical barriers, because different countries will have different regulatory bodies. But having this kind of forum where this can be discussed between everyone, I think it would be the place to start.
So I'm going to go, sorry, go ahead.
I just want to add one thing. You asked what needs to change with incumbents, among other things. I think what we've seen in the last several years, that incumbents more and more understand that they can't do everything themselves. And you talked about de-risking, and I agree. De-risking is also not doing everything yourself. It's relying on others and piloting more and making faster decisions and not necessarily in large committees. So I think incumbents are changing today to support more partnerships and run more pilots and see what is working more, investing more efforts into those areas. You see multiple tech companies that have tried doing financial services themselves in many sectors, and then have stopped only to partner at a later point with a company that can do it for them in order to de-risk their focus, their effort, their resources, and at the end, increasing their chance of success. So I think today, the incumbent players, financial institutions as well, are way more likely to collaborate. And the other side, which are the emerging companies, need to understand, like Kumar said, the de-risking of the incumbents. So what is the value for them? What is the value for the customer, as you said? but also what are they afraid of? How do you minimize the risk for them on the very large and main business that they are running, while creating more value for the customer?
So the work that I do on a day-to-day basis, I'm very fortunate in that I interact with companies around the world, and a lot of organizations that don't, are not based in Europe, point to open banking as being the thing that they wish they had in their markets. And this is irrespective of emerging companies, startups, or incumbents. Do you see that as the catalyst that has sparked all of this and made it real? Because when it came, there was lots of criticism, lots of negative stories around the implications of data opening up, people's information being made available. Do you see that as the necessary spark that every country needs to light in order to catalyze innovation? And therefore, to the point, Kumar, you mentioned regulator a few times. Is that where this journey begins?
Yeah, there's so many angles to this. I wouldn't credit necessarily open banking for sweeping in all the change. Open banking is very important architecturally. That's a architectural pivot, right? That actually opened up the possibilities and to reimagine how financial services could be constituted and delivered and consumed, right? So that's important. But there are other forces at play here which are beyond any one institution's control. I give you examples. Look at the mobile phones that we use, right? There are about 6.5 billion mobile phones around the world, and more importantly, there are twice that number of Internet of Things connected objects. So the whole internet that we know of is changing right in front of us. The internet, which used to be designed for human speed, is now beginning to evolve into machine speed. So there is autonomous decision making that is happening, machine to machine. So we're talking about going from 10 seconds to 10 milliseconds, from that range to from 10 milliseconds to 10 microseconds. So why do I bring this up? This is going to shape embedded finance. So this is the technology-inspired angle besides the architecture, which is going to, have people look at this. And the other aspect of it, which the industry is grappling and brings us back to the regulators, is you look at any institution, they're all talking about AI. And how should AI be, brought in to help with the decision-making, and what degree of autonomy you're willing to give. And the finance industry is much stricter than any other industry in that regards, rightfully so, because the guardrails are so important. So there, you don't find, at least in the US, regulators haven't come up with a position statement saying, thou shall use AI this way and not that way. So there, the industry has to take the lead to say, hey, here are the practical ways in which we can address bias. How can we make sure that underbanked, underrepresented communities are not ill-served by the decision-making that's happening, right? So explainability, which is hugely important. If I declined your loan, it's not enough to say I declined it. Why? And then you find, end-to-end automation of banks, right? Completely neobanks, end-to-end for certain processes. If you're putting in AI into that, you got to have the explainability behind it. And the technology is building up, so gradually the rules of the game are being written as we speak. And industry can inform the regulators and work together. And what we have seen is the regulators are very willing. FCA is one of the leaders in doing all the tech sprints.
Absolutely.
Right? Bringing participants together, doing that.
It's much more than lip service.
Yeah, and Guy's point, that's why Guy's point is so important of experimentation. I think regulators can help create that environment for it.
I think I want to add on regulation in general. I don't think regulation usually leads the change. I think regulation usually catches up with the reality and making it available for more countries or entities. Even if you look at open banking, so Klarna did payment initiation, or Sofort in Germany did payment initiation before it was a regulation, or credit companies that give you credit based on the text messages you receive before they could read your information from your bank accounts. And then when companies like that meet regulators, regulators over time understand that if they would open that type of technology to everyone, then the market would be more competitive, there would be more solutions, there would be more wealth over time. And then, in my opinion, regulation would catch up with reality and make things more available and easier to partner, easier to have embedded finance, easier to have more solutions. I can give you an example from Israel, where we are regulated both in Israel and in the Netherlands, passported across all of the EU. In Israel, we had one type of financial services license that is not banking. Now we have 8. Now, the regulator didn't make up all of these type of licenses. Those are actual companies that were already in the market, and then with specific regulation to disallow certain activities, but allow and enable more easily other activities. So I think regulation is definitely part of what is driving the change, but it is usually following a trend that you already see in the market.
So we don't need open banking, we need open-mindedness and then conversation. Great. I've just noticed I've gone completely off script, but we've spoken about top-down. I want to flip the conversation into bottom-up. If we think about two of these types of organizations coming together, what business models or commercial models have you seen work or not work? Are there certain best practices that you think are more suitable for these kinds of partnerships? Why don't we start with you? You're involved in a number of companies. One of them I know is involved in selling technology to football clubs, right? You help them understand football finances and the data behind it. Do you find that there's a certain type of commercial model that just works and makes these types of partnerships more easy to do? Or so is it that everyone has to win, or is it the standard good old license your software and you're done? What is working in the real market?
Yeah, the problem is there's different ways, right, as you mentioned, and they would depending on the different companies, because different companies will have different objectives, and some models will work for some companies and some models will not work for other companies. At the same time, it's really difficult to make it work, because, for example, if we have to price our product, you could say, oh, okay, this is the standard pricing that you have, and it doesn't matter which company you are. But we precisely deal with different sizes of football clubs, right? And they will have different capabilities. So how do you price for them? Do you do like, my take on that is, well, depends on your revenue, right? If you do more revenue, if we can help you to achieve more revenue, then if it's a percentage, or the pricing is based on the amount of revenue that you do, or at least on like ranges, it would be fair. So the problem that you have there is that you have different clouds. They would say, oh, why do we pay different when we actually have the same service, right? So it's really difficult to come up with a solution that works. And what it usually works better, or what we end up doing, is we have a modular pricing, where the core product would cost something. That core product serves the same for all the different customers, and they will have different revenues, right? So some of them would say, oh, I actually can pay more. What else can you offer me? So there's like a modular base, and some clubs would not benefit on some of our modules because they don't actually apply, because they are maybe more related with performance based on high-value players. So it's like, well, a small club would never need that. But when they need it, if they get to that point, then they can pay for it. So that way, you can do a pricing model that works for everyone. In that case, I do think that pricing model is the one that works better. And then just maybe you can have some, because obviously some of the financial services would depend on request, right? So maybe you always have like quotas where you say, okay, this is the minimum amount of our core product till here is this price, but then once you start doing more requests, more requests or more transactions, then your prices increases.
Interesting. If we go beyond price, right, in terms of commercial terms, to make these partnerships work, I often get asked, is there some way for you to have skin in the game? That's basically a polite way of saying I want a discount in my experience. But how do you feel these emerging companies in particular that don't have the resources of these large corporates can make themselves, make it commercially viable to work with these large institutions, but at the same time also be profitable as organizations? Are there certain best practices? Janine, you see stuff across the industry. Are you just seeing some people succeed because they have a certain commercial approach?
I think there's a couple of different answers to that probably, and there's different ways. But I'm just thinking about the traction that we've seen as of late tends to be from those companies that are very specifically answering a pain point or a challenge. And just thinking, for example, with regards to the ESG and the sustainability in the future, and the very critical role that fintechs can play in terms of supporting large incumbents, supporting SMEs, or reaching the net zero goals as well. We've seen some really phenomenal partnerships unleashed around this space, so between NatWest and Kogo, and Santander using Kogo as well, just as an example. So I think when you are solving a challenge and supporting in helping the incumbent do that, you're on a positive trajectory forward. But there are still quite a lot of challenges still to be overcome. There is something that was mentioned earlier. I think it's very important to think about the risk mindset and how you shift that at an incumbent level as well. There is also many less complex issues, so thinking of even the time scale that it takes to reach partnership between a startup corporation and a large incumbent is very different. But the skin in the game is also an interesting piece too. Yeah.
I'd like to add that commercially, we personally believe in long-term alignment of interest between the two entities. Which means, for example, if we're talking about revenue share, then the standard used to be from affiliates that gives you a single lump sum per customer to maybe will pay you for the first 12 months of customer activity. We actually believe in long-term, multiple years, or even throughout the lifetime of a contract revenue share, because then both sides have the same interest of maintaining the customer, providing the value to the customer, rather than having the value only for the first time the customer would use or in other purposes. So as long as the incentives are aligned, the value to both parties, then we've seen that the partnerships have been way more successful in that regard.
Yeah, I would add, Ash, I would add a couple of things to what's been already mentioned. I completely agree with Janine that, the fundamentals you can't escape, right? You gotta be solving the right problem and going after profit pools that make sense, right? Rather than crowding the space with the same capabilities that many others have. So that's always going to be there. The two aspects that I want to add to this is when we look at different business models, there's one that people are still trying to figure out how that might work. If it works, it's sort of explosive in its growth. And that's about, platforms that are created by ecosystems. So I give you an example here in Europe. So we have, for trade finance, we have a platform called V.Trade, which is actually created by 12 banks. And they actually fashion the process, fashion the onboarding, fashion everything. And IBM is a joint venture with these 12 banks. And the role there is basically to absorb the learnings and to create a cloud platform that actually enables that, right? And that brings me to the second point. When we use the word cloud, there's an implied business model already, right? I mean, you use your credit card, you just buy the drink you're paying, right? But what we've noticed based on our most recent surveys across sectors, there's no one cloud adoption. It's actually 4 genres of cloud. The very first one was people, the usual obvious things to convert CapEx to OpEx, right? So there's infrastructure as a service. That's a very straightforward model. The second model is, time to value. So, you're using specific silos of applications. You don't care about strategies and such. You very quickly, you want to build something. And so you go into one of these hyperscalers and you get the service. You're off to the races with that. But those are not the ones that are going to be transformative. The cloud version 3 and version 4 that are coming out are going to be. What is version 3? Version 3 is aligning your cloud model with your IT strategy. A software-defined enterprise. You bring in people, process, information. All of them, how are they going to take advantage of natively the cloud? And that's a huge challenge. People are not just going to willy-nilly move the applications onto the thing. It's going to be a progressive thing with the help of fintechs, with the help of others, right? So the collaboration we talked about. And the way forward is when the full business model innovation gets unleashed, because that's a mindset change, to use your word. It's really the mindset, where you're aligning the business strategy with the IT strategy. And as Guy was saying, it's an alignment across value chains. Now you got something going. And there, the technology providers, the big techs, or whatever you want to call it, tech fins, whatever the labels are, it doesn't matter. I mean, it's a play where all these things have to, come together, right? And you'll see many exemplars, and people are going to just then replicate it.
Excellent. I've got to say, I think we are out of time, aren't we, Flora? I saw the start time. I didn't see the end time of our panel. So
Yeah, it's like we have still a couple of minutes, so I don't know if the audience have any questions.
yeah, I was going to
or-
ask for that.
Yeah?
Please.
Great. Let's see the mic.
Thanks very much. So do you think, how ready do you think incumbents are with basic infrastructure like API capabilities to plug into products and services and plug theirs into various channels?
So how good are the API
Yeah, how
capabilities
ready-
as an
how ready,
example,
yeah.
or other capabilities? And it's not just, I'm guessing you mean it's not just having an API, it's how good is the damn thing. Does it perform? Yes,
And to get the data out and into those, right? Just the whole-
absolutely. I think this is directed at you,
Okay.
clearly,
So
Kumar.
let me answer Richard's question. So one way to think about it is, you think in terms of systems of engagement, which is the front office, if you want to map it to that. Then you got systems of insights, which are really the data that have to come together and the analytics. And then the systems of record. I think you will find more and more the API part of it is being addressed at the systems of engagement level. So that's where you've seen forum after forum where people have talked about customer journeys and how those are getting mapped, etc. Now, when you step down, it's non-trivial because there's a lot of service level agreements that you have to adhere to, regulatory compliance you're hitting against, and certain things, the netting and reconciliation of stuff, it's very easy to say, okay, today it's running overnight in a batch mode, we can just move to this, real-time mode. It doesn't happen. And that's going to take a while, right? But I think it's very important there for large financial institutions, and they're doing that through their innovation programs and so on, working with a lot of fintechs to fashion the API economy, so to speak, right?
Great. Do we have any other questions or?
All right,
Right.
I think that's time.
Yeah. I don't
Well-
know if you want to give any final thoughts.
Absolutely. I'm going to trigger the final thoughts. Are we going to be talking about this as an embedded finance in 5 years' time? Or is it just a done deal? It's going to happen and it's just going to be the way financial services works? Or do we as a group believe that we're still going to be talking about it because of challenges with infrastructure, because of the quality of APIs today, because of the speed at which we can all move? Is it going to be a point of conversation?
Yeah, if I can start, I think that embedded finance is a limiting term. You imagine finance somewhere in the middle, surrounded by something that is not finance. And when I look to the future, what I see is finance everywhere rather than finance within things. So the best type of solutions are where you don't even feel you're moving from a tech solution to a finance solution, when finance is just something that you do along the way. And I think in a couple of years from now, embedded finance would be funny as something that was very limited in the past, and today just something of the day-to-day of every large tech and non-financial company.
So we're going to look at it like bell bottoms and we're going to say, why were we doing that?
Yeah, I like the way Guy expressed it. It's finance everywhere, and I would even go further to say, if all the players did the right thing, it'll be invisible finance.
Yeah.
totally invisible. I mean, it's, it won't be sticking up. But having said that, I would say, as a thought, collectively for all of us, we cannot forget the grand challenges that the industry has to address. And one of the things which are very important is financial inclusion and diversity. This is so very important, regardless of whether embedded finance goes this way or that way. That has to be addressed, because lots of people and lots of SMEs are underbanked or underserved across the world, right? And that's sort of one. But we didn't even touch on financial crimes. That's almost 5% of the global GDP, right? And 90% of that is never solved. And for the industry to be taken even more seriously across all sectors, we got to be stepping up to that responsibility and doing it. Right? That requires even more collaboration and forums like Janine's.
There you go, Janine. He's queued it up for you beautifully.
Well, I'm going to say
It's
I
almost
love
like we
the-
scripted the whole
yeah,
thing.
it's almost like we planned it. Thank you. I love the invisible finance piece, because I think that's also where we'll probably end up. And whether we talk about embedded credit, we talk about embedded lending, we talk about embedded payments, all of this will ultimately, hopefully, become invisible in a few years' time, and just is what we do. So yeah, I think so as well.
I do hope that that's actually the future, at least from a customer point of view, is going to be like that. Technically, I do think that we will still have challenges and we will still talking about it, but at the end of the day, is what we do, right? So we will be solving the problems.
Wonderful. Well, thank you all.
Thank
And
you.
thank you for listening. I think that's us calling time. Thank you, Flora.
Thank you.
Thank you.